The agricultural and food industries are essential parts of any modern economy and country, so today we'll be analyzing a food processor and producer, which is Tyson Foods, ticker symbol TSN. This is the fifth episode of my subscriber suggested stock analysis series, so thank you to everyone that has been giving me suggestions, and if you want me to analyze a specific stock, just let me know in the comments below and subscribe to the channel, or you can also join the free Discord server, which will also be linked below, and that will kind of give you a little bit higher priority in the list. So most of you have probably heard of Tyson Foods, but they are one of the biggest producers of protein in the United States. Their main operations are in beef, pork, and chicken processing, and then they also have a number of brands of prepared foods that are bought directly by consumers. So they do split their business into four basic segments, the first three of which are beef, pork, and chicken. And all three of those segments are pretty similar. They basically just involve the processing of those specific animals into cuts of meat that other businesses then buy from them, such as food retailers, restaurants, hotels, schools, the military, and other food processors. The only notable difference in these three segments is that the beef and pork segment are not really involved with the raising of the animals at all, while the chicken segment is involved in the raising and growing of the chickens pretty much throughout their whole life, and then they are also processed when they are old enough within that segment as well. And then the final segment is the prepared food segment, which is involved in manufacturing and marketing frozen and refrigerated food products, and they do this with a number of brands and products such as Jimmy Dean, Hillshire Farm, Ballpark, Wright, State Fair, and some others. And the prepared food segment basically buys their actual meat from the three other segments within Tyson Foods for the most part. And this graph here is a breakdown of revenue by segment, so we can see beef and chicken each make up about a third of sales, and then prepared foods is about 20%, pork is about 10%, and international and other sales is less than 5%. In terms of how the company has actually been performing, most recently the business has really been struggling as they are somewhat of a commodities business, and their success really relies a lot on the prices of beef, pork, and the grain that is used to feed the chickens. And the issue is that the prices of the products that Tyson sells is much more rigid than the prices of the inputs for the company, because there's a lot of substitutes for their products. So for example, if the price of meat in the store is going up a lot, people will look to alternatives like beans, for example, or some other alternatives, just not eat as much meat. But the prices of the commodities are changing a lot. So as commodity prices go up, they can't increase the end product prices nearly as much to compensate for that. And that just results in a slowdown in the business and a shrinking of the margins. So right now they're somewhere in the down part of the cycle. For the third quarter of 2023, they reported revenue of $13.1 billion, which was down about 3% from the prior year. And for that quarter, they actually had an operating loss of about $350 million, and their income was actually negative $1.18 per share on a GAAP basis. So right now it's definitely not looking super great, and for the 2023 fiscal year they might not even make a profit. Right now, as far as their outlook goes, they are expecting to just about break even in the chicken and beef segment, and they're expecting to take a loss in the pork segment and then have some profit in the prepared food segment as well. But as I mentioned before, this is definitely a cyclical business, so as long as they can survive the downturn, which I think they likely will, they should come back stronger than ever at some point in the future. The difficult part of that is just determining when that will be and how long investors might have to wait until the business does recover. So I'll come back to some of these ideas more at the end of the video, but for now, let's move on to the balance sheet. We can see they have current assets of about $8.9 billion, which is significantly higher than their current liabilities of $4.9 billion, which is great to see, and that means they're in a solid financial position and shouldn't have any issues in the next year or two to pay off any of their obligations. The current portion of their debt right now is about $450 million, which isn't really too high at all. And when we add that to long-term debt of $8.9 billion, this gives us total debt for Tyson Foods of $9.3 billion, which is a little bit high for my liking, but not too terrible. And to kind of go into that a little bit more, I generally like to see debt to be no more than twice the company's net income. Right now, their net income is really struggling, so they're really nowhere near to that threshold right now. But during good times of the cycle, their net income was around $3 billion. So even then, that debt was a little high, more like 3 times their net income. They have done a decent job of decreasing their debt over the past few years, but it looks like it might start to creep back up here as they are running into significant headwinds right now and might have to potentially even take on a little bit of debt to be able to pay their dividend and stuff like that. But as we can see, they have almost $19 billion of equity, which is about twice as much as the debt that they have, which is a good sign. It is important to take into consideration as well that about $10 billion or about half of that equity is made up of goodwill from the many brands that they own. So if we do subtract off that goodwill, then that would give us debt and equity to be about equivalent, which is still solid, but not really as good, I think, as it initially looked. So my overall conclusion on the debt is that it is a little bit high for my liking, but it's certainly not unmanageable or out of control. But I do think it's important to understand that they probably won't be decreasing the debt all that much over the next few years, just because of how much the business is struggling. Now, Tyson Foods does pay a dividend, so let's take a look right here at some of those metrics surrounding that dividend, its sustainability, and its growth potential. So as we can see, they're yielding about 3.5% right now, which is on the higher end for companies I own, but that's certainly not a red flag per se or anything like that. Seeking Alpha does say their payout ratio is around 18%, but based on their trailing 12 months earnings per share of only 92 cents, that puts their actual payout ratio well over 200%, which is definitely not good to see and means that they'll probably have to, just use some cash to pay their dividend or potentially even take on some debt. But whenever they are able to recover from this down cycle, the payout ratio will most likely, I think, be well below 50%, as they have very consistently produced over $5 in EPS over the last few years. So they'll likely be able to do that in the future once they recover. They do have 11 consecutive years of dividend increases, which is a good start, but it's not a super long history or anything. And over the past 5 years, they've raised the dividend about 10% on average. I don't expect much dividend growth in the next few years, as they will need to conserve cash and won't really have much room to grow the dividend substantially. And they have also sort of already committed to not actually raising the dividend in 2023. They already declared all 4 dividends at 48 cents per share, but they won't lose their dividend growth streak yet, since the total amount paid in 2023 will end up being $1.92, which is greater than the $1.86 that they paid in 2022. So as long as they raise the dividend at some point in 2024, they will keep that dividend growth streak alive, and hopefully at some point the business will start recovering sometime in 2024 and will give them the opportunity to raise that dividend sustainably. Moving on to valuation now, we'll take a look at the PE ratio first. Because of the declining earnings the past few quarters, the PE ratio does look pretty bad. Right now it's at 57, but we'll take a quick look anyway, and we can see compared to their historical PE ratio of about 12.5, that looks very overvalued. But the earnings have fallen drastically in 2023, and more than likely when they do recover, they will recover pretty quickly as well. So, at that point, the PE ratio will be a lot more attractive, I think. I also usually look at the PE ratio in a company's respective sector and industry, but in this case, most of the companies in their sector and industry aren't directly related to the processing of meats and protein, and so I think some of the issues they're facing are kind of specific to them. So it doesn't really help us a whole lot, I think, to compare their PE ratio to their industry and sector. But if we would basically just see that their PE ratio is much higher than the rest of their industry and sector right now. I also usually use a discounted cash flow model to estimate the fair value of a company. And I think in this case, this method will be a little bit better than the PE ratio for understanding Tyson's valuation, but I think it's definitely still not ideal, since their free cash flow has been hurt a lot by this down cycle, and it's hard to predict where it's going to be at in the next year and the year after that, and then how quickly it will recover and stuff like that. But from my calculations, I came up with a fair value of $62, as you can see, and that gives us a buy price of $56 when we apply a 10% margin of safety. So that makes the current price of $52 look just a tiny bit undervalued, I would say. The numbers I used, I think, were pretty conservative on the whole, but it's really hard to tell because most likely the free cash flow in the next year or two will be pretty small, if not negative. And then after that, as they start to recover, free cash flow should ramp up pretty quickly. So it's kind of hard to estimate that transition and get a, kind of averaged out estimation of what that fair value would look like. On the whole, I do think Tyson Foods is quite a solid company that is just going through one heck of a downturn in their cyclically natured business. they could definitely continue to struggle for a few years as they may have to take on more debt to fulfill some of their obligations since they won't be bringing in much interest. And added on top of that, the issue that their debt is going to be at much higher interest rates in the coming years than it has been in the past few years. That could definitely hurt them. But the current stock price does look a little bit attractive right now. I think two things would really need to happen before I am interested more in investing in Tyson. The first thing really is that I would want to understand the business a little bit better, especially in terms of the way that commodity prices affect their input costs, and then what kind of pricing power they really have in terms of their selling prices, and how those compare when one fluctuates, how much they can adjust their selling prices. The second thing really is that I would want to wait until the business is recovering a little bit before investing. Peter Lynch generally advocates that with cyclical companies like Tyson, you should wait until the bottom of the cycle is reached and the company is starting to improve and recover a little bit. So you definitely don't want to wait too long because then the stock price will go up higher and you won't get as good of a deal. But I think the thought process behind that strategy is that you want to make sure that the company is really recovering and is really kind of in a cycle as opposed to just a dying company before you would invest in it. So that will be my strategy with Tyson, but I would love to hear your thoughts regarding the company and let me know if you do own any. Again, if you want me to analyze a specific stock, make sure to subscribe to the channel and join the Discord, which will be linked in the description, and let me know there what stock you want me to analyze. And the Discord server is also just a great way to talk to other long-term investors on a regular basis, and you can talk about what's going on in your portfolio, what you're thinking about, and kind of just bounce some investment ideas off of each other. That certainly helped me out with some of the people in that Discord. So thanks for watching to the end of the video. I really do appreciate it, and I'll see you all in the next one.